So I've received this question here on my YouTube channel. Hey Ian, what if you could only own one dividend stock? What if you had to take all 37 of your positions right now in your dividend stock portfolio, you had to sell 36 of them, and you had to put the proceeds into one dividend stock? Which would be the one that you would feel most confident holding? Which is your favorite one? Which is your forever stock when it comes to dividend growth investing? Well, I want to share that stock with you today. And in fact, this stock is already my largest holding in my portfolio. And it was actually difficult picking one. I actually have a number two that is really close behind, but this is the one that came out on top. And I'm talking today about Johnson & Johnson. So welcome to the video, everyone. So excited to have you here today. Thank you for the amazing questions that keep coming through. This was a fun question that I've received. I really like this question because it helps me put things into perspective. As a dividend growth investor, if I were to pick only one stock, I would feel so confident owning Johnson & Johnson. I would feel really confident if that were the only stock that I owned. I would sleep at night like a baby. I would have no problems holding this one stock if that were all that I could own. And so I want to take some time today to go through Johnson & Johnson, why I have so much passion for this company, and what this company means to me from a dividend growth perspective. So let's just start with some high-level points. Before we even get into the numbers, I think it's important to just look at the big picture. What is it about this company that I like so much? Well, first and foremost, it is predictable. This is the type of company that when one looks at the annual report, one looks at the numbers over time, it is so predictable. It is like clockwork that the revenue increases, the earnings increase, the dividend increases, and the numbers are predictable. I love that predictability. Number two, margins. There are very few companies out there that have the kind of margins that this company offers. We'll get into it later, but I love companies with strong margins because margins create security, and also margins give flexibility to companies that have strong margins. More than that, strong margins are indicative of a well-run company and a company that truly has hit its stride in the marketplace. What else? Population. One cannot ignore the global factors out there, the meta-level factors that influence a stock portfolio investment. As we all know, the population is starting to age, and especially in the United States population is starting to age. The baby boomer generation is starting to age, and these very consumers, these very people are going to need increased medical care, increased health services over the coming decades. And so I think the meta-level demographic factors are in favor of this company right now. However, that said, I think this is a pro and a con. Looking way out, I think that certainly the millennial generation needs to start having more kids, and the population needs to start growing again. But that said, globally speaking, the population continues to increase. And so I think there's a number of population-related factors that are in favor of Johnson & Johnson right now. What else? Dividend growth. I invest for dividends and cash flow. One day I will live off of my dividends and literally use my dividends to pay bills. And so I love Johnson & Johnson because it's a shareholder-oriented company. It's one that cares about its dividend. It's one that increases its dividend like clockwork, and we'll get more into that later. It's a global company. We'll get more into this later, but I like a company that has a global footprint. This company actually has nearly half of its revenue coming internationally versus US, and so that's really exciting. I think there's more work to be done, more opportunity overseas, internationally, but they're already taking advantage of the global world that we all live in. Diversified. If I were to own only one company in my entire portfolio, I sure would want a company that is diversified, and we'll get more into this later, but Johnson & Johnson is quite diversified. I like to think of Johnson & Johnson almost as a mutual fund of the healthcare space. They're just in so many different niches within healthcare. They have made so many acquisitions. They are just so big that it's almost like owning a mutual fund by owning this huge, huge company in the space. So those are the high level themes. Let's go down now into the numbers. Why do I like this company so much? It is just such an amazing company. Let's just look at the revenue. I'm going to start with 2017 revenue. I pulled this from their 10K, their annual report for 2017. 39.8 billion comes from the US and then 36.5 international. So it's almost 50-50, not quite there. It's still kind of skewed towards US, but we're getting there. And so that's something that's unique. I get a lot of questions here on my YouTube channel. Hey, Ian, do you like to invest internationally? And I do own pure play international companies. But the reason that I like this company is I don't even need to own a pure play international company. Just by owning Johnson & Johnson, it's already a global company that's driving a lot of revenue both from the US and internationally. This is a company, by the way, that has a market cap of $338 billion. This is a very big company. And so if I were to own only one company in my portfolio, I would want something that is big, that has staying power, something that's not going to get acquired by a competitor, not something that's going to be disrupted away. And so something this big, it has a lot of staying power. And one note actually on all of this that I didn't really jot down here, but that whole point on staying power. I've done some videos recently. We've talked about Amazon and how Amazon is disrupting in some ways some of the traditional consumer non-cyclical companies. In my opinion, this is somewhat of a disruption-proof company. We'll get more into later about patent expiration. I think that's one of the things that could potentially create disruption and if there were any risk, that might be one area for risk. But in general, I do not see Amazon coming along and potentially getting into their space or disrupting this company. In fact, I view Johnson & Johnson as the disruptive company, as the technology company in the healthcare space. And so I certainly place a lot of weight in that and a lot of weight on this big market cap. So what else? The revenue growth has been phenomenal, and it's been not only phenomenal in its scale, but also in its predictability. So I just jotted down here, in interest of space, 2 years, 2017, 2007. The interesting thing about this company is their annual report. They actually go back quite a bit in time. Most of the annual reports I look at, by the way, I do a lot of these analyses on this channel. Maybe they list the last 2, 3, or 4 years. But Johnson & Johnson, in their annual report, they go all the way back to 2007 and they list it year by year. So it really makes it easy for investors like myself who care about fundamental analysis to look at all the numbers. But anyways, I jotted down just 2 of them here because I can't fit it all. But in 2007, they did $61 billion in revenue. 2017, $76.5 billion. An increase over those 10 years of 25%. That is great top line growth for a company that is already at this scale. A company already this big to achieve top line growth. So strong, so phenomenal. I think that is just simply wonderful. And what I like about the top line growth too is it wasn't lumpy. It didn't just come in 1 year or a few years. It was pretty stable over all these years. And some of the earlier years, back around 2017, it had some, or 2007, it had some ups and downs, but more or less it was stable. And so I'll give you a flavor of that. In 2017, it was 76,450, 16, 71,890, 15, 70,074, and so on and so forth. And so what I've noticed in general, and it does have some ups and downs, but it's somewhat smooth over time, and I really like to see that on the revenue growth side of things. Margins. This is really unique to Johnson & Johnson, something I don't really see in many other companies, certainly some other companies, but it's just, to be in this kind of space and have these kind of margins, it really amazes me. Anyways, their gross profit margin is 66.8%, meaning their cost of goods sold, COGS, it's only $25 billion on a revenue of $76.5 billion. And so that gross profit percentage is phenomenal. And now the operating profit in 2017 comes in at about 23%. Again, really phenomenal margins. Really happy with those. And I feel good about these margins because they're not skimping. They're definitely, when I look at their annual report, I look at their numbers, They're not skimping on sales, marketing, and administrative costs. They're certainly not skimping on research and development. It keeps going up year after year after year. And so I feel like they're being proactive on investing in their people, their business, but they're still maintaining these really phenomenal margins. And so I really like that. I'm really a fan of those margins at Johnson & Johnson. Moving down here, earnings per share. Just a note to everyone out there, some of the newer investors here, we've talked about this before, but if you're new to my channel, if one goes to Yahoo Finance right now and one looks up Johnson & Johnson, the PE ratio looks really wacky. It's something in the several hundreds. It almost looks like the PE ratio of a tech stock like Amazon. However, the PE ratio is not accurate right now. The reason being is Johnson & Johnson is taking advantage of tax reform to do some tax restructuring and most likely repatriating dollars into the US. And so when one looks at their income statement, in the most recent annual report, there was a big line item under taxes. But basically what I do in this case is I like to look at years before and try to back into an earnings per share. I'm not perfect at it. It's very back of envelope. But basically I've been able to back into an estimated earnings per share if you factor out tax reform of about $5.50. And that puts the price earnings ratio, taking the current price of $126, I divide by that 550, it gives me a current PE of around 22.94. I actually think my PE ratio is a little bit high, and I think my earnings per share is a little low. And the reason for that is I know with the new tax reform, corporate tax rates are lower, but I'm still estimating my earnings per share based on the old corporate tax rates. And so anyways, I think my 550 is a little bit conservative. I think their earnings per share is likely better than that. We shall see as the numbers for 2018 and 2019 progress and unfold. But in general, this is kind of the ballpark we're looking at now based on my back of envelope analysis. And the point of this is, one, dividend investors, be on the lookout in case you're looking at numbers on Yahoo and they look weird. There's a lot going on with tax reform now. But two, I think the other meta level point here is this stock is currently, in my opinion, not trading at a discounted value. I mean, a PE in the 22.94 range, and maybe it's lower, maybe it's more like 20 if my EPS goes up, which it probably would. It's probably a little bit conservative there. That's pretty high. It's a pretty lofty valuation, and it's, in my opinion, priced fair, if not aggressive. The reason for that is this is just one of the best companies in the world. It doesn't really get better than this. I think everyone out there realizes that, and everyone wants a piece of it. And so when that is the case, the company gets bid up. Certainly, it's not trading like a lofty FANG like tech stock, and certainly it's not trading at crazy multiples, but it's certainly trading at fair multiples, and it's not at a discounted value like some of the other stocks I cover here on my channel, in my humble opinion. And so right now, other than reinvesting my dividends, I'm not very much an active buyer of Johnson & Johnson. It's not a focus of me in 2018. However, maybe that would be different hypothetically if I can own only one stock, or if I were just starting over again, that may be different. But right now, being my single largest holding and feeling that it's not really trading at a value, I'm not really a buyer here, although I definitely want this stock to continue to be my number one holding. I definitely want it to continue to lead the pack. And so I will, over time, be adding to this. I am hoping at some point for a buying opportunity. Whether that presents itself, one never knows. And honestly, with this stock, I'm okay buying it when there are not buying opportunities. I feel comfortable really buying it pretty much at any reasonable valuation just because I like the company so much. But right now, certainly on this side of things, on PE side of things, I don't really see a deep discount. And on the dividend yield side of things as well, I don't see a deep discount right now on the current dividend yield of this company. So what else? Right now, the dividend for the year of 2017, it was $3.32. And In 2007, it was $1.62. One of the reasons that I'm pointing this out is the dividend over time. It has increased by 105%. This is a fabulous, fabulous increase just over that 10-year period. The dividend has basically doubled. And it is not every day that a company can increase its dividend that much. But what I really want to point out as well is two things as it comes to the dividend. Let's start the payout ratio. The current payout ratio is about 61%. If one takes the dividend, divides it by the estimated earnings per share that I have of about $5.50, the payout ratio comes to 61%. This means there's a lot of money left over after the dividend is paid. And that money, theoretically, could be used over time to increase the dividend. What this means is there is a margin of safety. There is an ability here over time for Johnson & Johnson to increase their dividend, even if the business stagnates, even if revenue stagnates, which I don't believe it will, even if earnings stagnate, which I don't believe they will. This payout ratio is conservative. This is a very conservative company. This is one of the things I like about the company. And again, going back to the question here, if I could only own one stock, I would want to play things safe. I want to be conservative, and I like how this company conservatively manages its payout ratio. Also, I've done some videos here. In the early days, or maybe not so early days, but I've done some videos I'll link below on hypothetical situations, how to get started with $1,000, $10,000, so on and so forth. And one of the things I always mentioned, a challenge actually to subscribers that I mentioned is, hey, look for those stocks that can predictably grow the dividend. They not only increase it a lot over time like this company has, but they do it predictable. Each year it's pretty predictable. Check this out. In 2017, they raised it by about 5%. 2016 by about 6.8%. 2015, 6.9%. 2014, 6.6%. You see a trend here. It's usually in this 5-6% range. It's pretty predictable. I think the 2017 raise was a little lower at 5%. That's okay, but before that it was really in the 6%, actually high 6% range. And so this is an example of a company where not only over time has the dividend increased a lot, but it's been pretty darn predictable. So I really like that. I'm really a fan of that with Johnson & Johnson. So one other thing I want to mention on Johnson & Johnson. At a high level, this company operates in 3 segments, and those segments are pharmaceuticals, medical devices, and consumer products, consumer health-related products. You've probably all seen them in your local drugstore. And so the thing with Johnson & Johnson is the revenue is split pretty well. Pharmaceuticals is $36 billion in revenue per year. Devices, $26 billion. Consumer, $13.6. Each of these segments is meaningful. Each of these segments has meaning when it comes to Johnson & Johnson's business. Also, when one goes in the annual report and looks at the segments, they're all doing pretty well. They're all showing reasonable growth. The one, though, that is growing the most is pharmaceuticals. And so if one were to think what is a risk with this company, if you're new to the healthcare space, one of the things to be aware of with new drugs that come out is, one, there's a drug pipeline, and Johnson & Johnson shares that in their annual report. What's their pipeline? These drugs need to get approved by the FDA, by other agencies internationally, and it's always good to have a company that has a strong pipeline. And the reason one wants to have a strong pipeline is the patent on these drugs is only 20 years. After 20 years, they can go generic, meaning the patent expires. Other companies out there can produce the same thing, the generic version, and then the revenue that a company like J&J is generating will go down. And so it's this churn and burn. You're not going to see this as much with medical devices or with consumer products. With the pharma side of things, there will always be this churn and burn because there's always these drugs coming off of their 20-year patents that require a new one to come in to have a strong pipeline to always replace and also grow the revenue over time. And so if there was a risk, I would say that's one risk. There's this churn and burn. It's not a forever product because the patent expires. The other thing I would say with this company is healthcare costs. The cost of healthcare right now, especially in the US, it's astronomical, and it's a real problem. It's actually, there are some forecasts that are going to say that the amount of money that's going to go out over the next so many years from Medicare payouts is going to be more than the tax revenue that's ever been collected in the history of the United States. And so there's a real issue with the pricing of these products. And so over time, my question becomes, is the revenue from the pharma side, especially in the devices side in particular, sustainable? Will there be a great reckoning where the government works with the hospitals and works with the medical pharma companies like this one and tries to do something as it pertains to pricing? I just don't know. I think that's kind of out there, and I think they certainly have a lot of international revenue as well, and so I don't tend to worry about that as much. But I think if there was another risk in addition just to the 20-year life cycle of each of these drugs, and it's not a 20-year, once they're on generic, people still will buy from them, revenue will go down. If there was another risk though in addition to that, I would say it would be that just the general pricing of healthcare being kind of crazy. So before I end today, I just want to go actually through some of my own history. I wrote down some of my own experience here that I thought would be really fun. So my experience with Johnson & Johnson, it actually dates back all the way to 2001. This is one of those companies that was one of my early ones. This was one of my earlier investments. I'm really proud of that. I've been involved with this company for a long time, and it's always just been a core stock. It's probably always been between my number 1 and 2 in terms of my favorites. And certainly now number 1. Number 2 is kind of close. I'll have to do another video on my number 2. It's in a completely different industry. And I'll tell you though, even though I was involved with this since 2001, I got really serious with this company in 2011. And 2011 is where I really started doubling down, and that was when it was trading at about $58 a share. And so certainly now it's at $126 a share, so it's gone up quite a bit since then, and that obviously doesn't even count the dividends I've received. But basically, if I take my my current dividend that's being paid by this company, which is about $3.36, and I divide it by my purchase price, which was $58, I get a yield on cost of 5.76%. Certainly this is not my best yield on cost. 5.76, I can find companies out there right now in this current market that offer a starting yield of that amount. And I was looking earlier today, I own a stock in my portfolio right now, unbelievable. I am yielding 17.5% yield on cost. So I have stocks that have performed from a yield on cost standpoint better than this. I can buy stocks right now that offer a starting yield much higher than the starting yield on Johnson & Johnson, because this stock, it is priced a little bit higher. It is priced because of it really is a premium name. That said, I cannot underscore the value of being predictable, having the margins, having all of these factors, because when it comes to sleeping well at night, in my opinion, I love having those kind of stocks in my portfolio. And again, if I could only own one stock, I would want it to be the most stable, the most robust, the one that I just felt so comfortable with. And I certainly, if I could only own one stock, I realized I wouldn't have the most amazing yield on cost here. But what I could rest assured on is this company will be around and it'll keep growing its dividend. And quite frankly, it's a generational company. This company, in my opinion, is going to be around for generations and generations. And so that's what it comes down to for me with this one stock. But again, it's not the same in terms of yield on cost as some of my other holdings, and certainly not the one that I was looking at earlier today that offers right now for me a 17.5% yield on cost. And so that's an important nuance. I think that's a downside with something like this, is all of this perfection that comes with this company does come at a cost. It's been bid up in the market. So thank you so much. Thank you for that question. That was a really fun question. I really appreciate that one. And please keep them coming. If you enjoy the videos on my channel, I invite you to subscribe, to like, to comment. If you have questions and you want them answered really quickly, and by the way, I answer all the questions here on YouTube, but if you want to get in contact with me even quicker, go on to Instagram. I'll link to it below. I am answering questions there as well. Just comment on one of my photos publicly, and I will do my best to respond typically in the same day. Before I leave today, A few things. In terms of full disclosure, I personally own stock in Johnson & Johnson. I am long on that stock, ticker JNJ. Also, in terms of a disclaimer, I'm not a licensed financial advisor. Today's video is not investment advice. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. Before we leave, I'd be curious, I'm obviously sharing my favorite stock today with all of you if I could only own one. I invite you in the comments below, please share with the community if you could only own one stock, one dividend stock in your portfolio, which one would it be? Would it be Johnson & Johnson? Would it be something else? Which one would it be? And I'd also just be curious, what do you think about Johnson & Johnson? Do you like it? Do you dislike it? And let's get some great discussion going here, because I think we could all benefit in this community, and we all are benefiting in this community from the great discussion. So thank you so much for hanging in there with today's video. Thank you for the support, and I will see you in the next dividend investing video.